There's a pattern that consistently shows up among traders going through a difficult stretch. When losses start compounding, the instinct is to respond. Adjust the strategy, add a filter, find the flaw in the setup, try something different, do more. It feels like the right move. You're not passive, you're problem solving. You're taking the situation seriously. But this is exactly where the structural misunderstanding lives. The assumption underneath all that activity is that the losing streak is a technical problem, something broken in the analysis or the setup, and that the solution is to find the fix that technical flaw. In most cases, that assumption is wrong, and acting on it tends to extend the streak, not end it. In this video, I'm going to explain the logic behind that instinct, why it breaks down in real markets, and how professionals actually think about periods of drawdown. Well, this isn't a critique of anyone who's experienced this. It's a structural explanation of why a very reasonable sounding response produces the completely wrong result and what the correct framing looks like instead. The logic behind active troubleshooting during a losing streak is straightforward. Trading is an analytical discipline, and when something repeatedly produces bad outcomes, the rational response is to examine it, identify the error, and correct it. And that's how almost every other skill-based domain works. If a process is producing failures, you diagnose the process and fix what's broken. And applied to trading, this usually looks like reviewing recent losing trades in detail, identifying where the entries went wrong, and making adjustments. Maybe the stop was too tight. Maybe the setup criteria needed tightening. Maybe a different indicator would have filtered out the bad trades. The trader's working hypothesis is, I'm losing because something in my technical approach is flawed, and if I can identify and correct that flaw, the results will stabilize. This feels responsible. It feels like the kind of analytical thinking that separates serious traders from undisciplined ones. And in certain circumstances, it is the right approach, particularly if the losses are clearly outside a trader's defined rules and the strategy genuinely hasn't been followed. But here's where the logic starts to fracture. The approach assumes that the most recent sequence of losses is meaningful data about the strategy's validity. It treats a short sample of trades as a reliable signal that something needs to change. And in probabilistic systems, which is exactly what trading is, that assumption is structurally flawed. Understanding that is the starting point for everything else. Trading strategies produce outcomes through probability, not certainty. Even a sound strategy with a real edge will produce stretches of consecutive losses. And that's not a flaw. That's how variance behaves in any probabilistic system. When a trader begins adjusting their approach based on a short sequence of losses, they're essentially mistaking normal variance for evidence of a broken process. They're making a structural change to something that may not need it. And in doing so, they introduce new variables, untested criteria, unfamiliar setups, inconsistent rules that actually do break the process. This is sometimes called strategy drift. The original approach, which had defined logic and tested boundaries, gets quietly replaced by something modified under pressure. The edge that existed, if it existed, is no longer being applied. And there's also a compounding effect. When adjustments don't produce immediate results, which they often don't because they haven't had enough time, the trader adjusts again. Each change feels logical in isolation, but the cumulative effect is a trading approach that no longer resembles anything coherent. The market doesn't care about the trader's recent experience. Price behavior isn't responding to the fact that the last 5 trades were losers. The only question markets answer is whether an edge, applied consistently and correctly, produces favorable outcomes over a statistically meaningful sample. Short-term sequences tell you very little about that. Changing your strategy based on them usually creates more problems than it solves. I don't evaluate the validity of a strategy based on short-term outcome sequences. I evaluate it based on process integrity and sample size. The question I ask myself during a losing streak is not, well, what's wrong with my analysis? Was my process followed correctly? And is this sample large enough to mean anything? If the process was followed correctly and my sample size is small, my interpretation is almost always, there's a variance. That doesn't mean doing nothing. It means continuing to execute the defined process while monitoring whether the losses are expected within the expected statistical range. If the process was not followed correctly, that's where the real work happens. But the correction is almost never in the technical analysis. It's in the execution discipline. Did I take setups outside my defined criteria? Did I increase position size under pressure? Did I exit early because of discomfort? These are process questions, not strategy questions. The distinction matters because it points to entirely different corrective actions. Fixing a strategy looks like adjusting criteria, adding filters, and changing what you trade. Fixing a process looks like reinforcing rules, slowing down decision-making, and restoring structure around execution. And professionals understand that their confidence in the system should be based on the system logic and historical behavior, not on what the last 10 trades produced. Separating those two things is a cognitive skill that takes time to develop, but it's foundational to long-term trading stability. This misunderstanding persists for a few reasons that are worth understanding on their own terms. First, the feedback loop in trading is designed to make outcome-based thinking feel correct. You make a trade, you see a result, you form a conclusion. That sequence, action, result, interpretation, is how we learn in almost every area of our lives. The problem is that it only works reliably when the sample size is large enough to separate signal from noise. In trading, most traders never accumulate enough trades in a single defined setup to know whether they're seeing a signal or noise. So, they draw conclusions from insufficient data, and those conclusions feel accurate because they're based on direct experience. Second, the content and education ecosystem in trading reinforces this pattern. Most trading education is structured around identifying what's wrong with your setup and fixing it. There's enormous emphasis on finding better indicators, refining entries, and tightening criteria. The idea that the setup might be fine and the trader simply needs to wait is less appealing and less visible. Third, activity feels like progress. When a streak is happening, doing something, anything, reduces the psychological discomfort of uncertainty. Adjusting the strategy feels like control. The structural correction, slowing down, reviewing process, waiting, feels passive, even though it's often the right call. These are understandable dynamics. They're not signs of poor thinking. They're signs of a framing that hasn't yet been corrected. At position trading timeframes, the correct response to a losing streak is almost always a process review, not a strategy overhaul. The first step in that review is simply determining whether your defined rules were followed, not approximately, precisely. Position trading depends on a small number of high-quality decisions made with patience and clarity. If those decisions deviated from the rules, even slightly, that deviation is the starting point. The second step is evaluating whether the losses fall within the normal variance range of your approach. This requires having some baseline expectation. What does a normal drawdown period look like for the system? Without that baseline, you can't distinguish between expected variance and a real performance problem. The third thing to consider is whether market conditions have shifted in a way that genuinely affects the applicability of your strategy. This is different from adjusting because of recent losses. It means asking whether the structural context in which the strategy was designed remains present. Conditions do change, and recognizing that is part of long-term adaptation. But this is a slow, evidence-based assessment, not a reactive conclusion drawn from a few bad trade results. Position trading's longer time frames provide something valuable here, more time between decisions, and that creates space for deliberate review rather than reactive adjustment. Use that space. It's one of the structural advantages of trading at higher time frames, and it's worth leveraging. The instinct to fix things quickly during a losing streak is understandable. It comes from good intent and a genuine desire to trade well. But the structural reality is that most losing streaks are not best solved by changing your strategy. They're best addressed by restoring process integrity, reviewing whether your rules were actually followed, and distinguishing between variance and real breakdown. That requires slowing down instead of speeding up. It requires asking questions different from the ones that feel most urgent. And it requires accepting that a short sequence of losses is not a verdict on your approach. Position trading, by its nature, demands exactly this kind of patience. Not passive patience, structured patience. The kind that comes from having a process you understand well enough to clearly evaluate. The complete 5-step framework for ending a losing streak, including how to set structured rules, manage decision-making under pressure, and build a review process that prevents recurrence, is covered in a full article entitled Ending a Losing Streak for Forex Traders in 5 Steps, and you can find it at positionforex.com. The link is in the description. That article is the reference for everything discussed here, and it goes in the depth this video can only introduce. Until next time, best to your trading.